What is the accounting equation and why is it important? I'll talk about that in this video. My name is Katherine, I'm your accounting tutor, and I help accounting majors through graduation and beyond. Today we're going to talk about the accounting equation, which, as you might already know, is assets equals liabilities plus equity. Assets include anything that benefits the business: cash, property, plant, and equipment, inventory, other people owing us money, also known as accounts receivable, buildings, things like that. It's everything that benefits the business. That's on one side of the equation. And then on the other side, we have liabilities plus equity. Liabilities are claims that other people have on the assets of the business. Usually that's through money, but not always. Different types of liabilities include accounts payable, which is usually short-term, notes payable, which is usually long-term and can include interest charges, and unearned revenue, or sometimes called deferred revenue, which is when customers give us money before we provide the service. This can be from gift cards or subscriptions. Equity is the owner's claims on the assets of the business. There are two different types of owner's equity. One is through owner's contributions, when the owner takes money out of their personal pocket and they put it into the business. This is through common stock, sometimes called owner's contributions. And that's one way that you get equity. Another way is through retained earnings, which is earnings, meaning net income, that the business has retained, meaning not paid out in dividends. So as you might have figured out from that, the two things that touch retained earnings are net income, which increases our retained earnings, and dividends, which decrease our retained earnings. So to recap, assets, everything that benefit the business, they can either have claims on it from liabilities, other people having claims on the assets, or equity, ownership having claim on the assets. There can't be any assets that nobody has a claim on, and people can't have claims on assets that don't exist. So you can see that that balances itself out really nicely. Because this is an equation, when one side goes up, another side also has to go up. When one side goes down, the other side goes down, or potentially on the same side, it goes both up and down, and the other side is unaffected. As an example, if the owner contributes money to the business, then the cash asset of the business goes up, and owner's equity from the owner's contribution also goes up, and so our equation stays balanced. If the owner then takes that cash to buy, let's say, inventory for the business, then cash, the asset, goes down, and inventory of the business goes back up, and so again, the equation stays balanced. If we want to borrow money from the bank for our business, cash goes up, and the liability of the note payable goes up. And so again, the equation stays balanced. Revenue and expenses of the business ultimately impact the equity section because, as we talked about before, net income affects retained earnings. And how do we get net income? From revenue minus expenses. So revenues increase the equity of the business and expenses decrease it. So if we make a sale of a service, let's say I have a business mowing lawns. If I sell that service of mowing lawns to somebody, then the cash goes up, and assuming they pay us cash goes up, and our revenue of sales revenue, service revenue, also goes up. And so assets up, equity up, the equation is in balance. If we perform a service for somebody and they don't pay us right away, what that's called is accounts receivable. And essentially, we're letting them pay us with an IOU. So again, our service revenue would go up, our equity would increase, and so would our accounts receivable, which is also an asset to the business. Even though they didn't pay us cash, it still benefits us because they owe us money. And then when they finally do pay us, our account receivable will go down and our cash will go up. And again, everything stays balanced. So hopefully you can see kind of how all these different pieces play together. Unfortunately, accounting isn't actually done with ups and downs. We call them debits and credits. Debit is the word we use for something on the left-hand side, and credit is the word we use for something on the right-hand side. Now, students always want to try and make comparisons between these debits and credits and the debit and credit cards in your wallet. I've thought about this a lot. There are no similarities. There's no comparison to be made. Just think of debit on the left and credit on the right, and try not to overcomplicate yourself. So back to our accounting equation, it's assets equals liabilities plus equity. Now, if you can really get that in your mind, then you can know that assets go up on the left because it's physically on the left-hand side, meaning that assets increase with a debit. Liabilities and equity increase with a credit, and we remember that because it's physically on the right-hand side. So assets increase with a debit, decrease with a credit. Liabilities and equity increase with a credit, decrease with a debit. When I was a student, I was really stuck for a bit on why this goes up with a debit and why this goes up with a credit. And my brain just couldn't really figure it out until I realized that that's the way it is because that's the way it has to be. In order for our accounting equation to balance, assets equals liabilities plus equity, and in order for our debits and credits of the business to balance, assets have to go up with a debit, liabilities and equity have to go up with a credit, and that's all there is to it. Another thing that students like to do is sometimes they like to think, oh, well, a debit is good and a credit is bad, and they use that to kind of help them with accounting problems. And that's also not the right way to do it. There really isn't a good or bad. There's just left or right. Good or bad depends a lot on what you're going for in your business. For cash, you think in general cash increasing is a good thing. Well, cash increases with a debit. But for revenue, revenue going up is also generally a good thing, but revenues increase with a credit. So thinking about them as good or bad, again, is just another way to confuse yourself. Really just think of debit means on the left, credit means on the right. If you'd like a free cheat sheet to help you keep the debits and credits straight, just click the link down below and you'll get it there.